I just added a stock to my portfolio that pays monthly dividends, and the yield right now is over 13%. Not quarterly, monthly, every single month. And here's the detail I want you to hold on to. This company has never cut its dividend, not once, across more than 6 consecutive years of payments through 3 rounds of Federal Reserve rate cuts, and across a broader sector where some of the most well-known names have already started trimming payouts. This company has kept the distribution stable or growing every single quarter. In fact, they didn't just hold the line, they went in the other direction. Starting January 2026, they switched from quarterly to monthly distributions to better align with shareholder interests. At $0.17 per share per month, that annualizes to roughly a 14% forward yield at current prices. Now, if you've spent any time in income investing, you know that a 14% yield with a perfect dividend track record sounds like a setup. And honestly, I thought the same thing. So today, I want to show you exactly why I pulled the trigger. What structural features set this company apart from nearly every other high-yield stock in this category, and just as importantly, what the real risks are, because there are some. The company is Trinity Capital, ticker TRIN. By the end of this video, you'll understand 3 things most income investors miss entirely. 1, why a 13–14% yield isn't automatically dangerous, but also isn't automatically safe. 2, what specific structural features protect Trinity Capital's income when interest rates fall, something almost no other company in this category actually has. And 3, what metrics I personally watched before buying, and what I'm continuing to monitor closely. This isn't a pitch, it's a breakdown. Let's get into it. Here's what's happening in high-yield income investing right now. A lot of people chase yield. They see 12%, 14%, sometimes 18%, and they buy without understanding why the yield is that high. What happens next? The dividend gets cut, the stock price drops, and suddenly your 14% yield is 9%, but your capital is down 25%. That's not just a portfolio math problem, that's a retirement income problem. That's I was planning on this cash flow turning into now I have to restructure everything. The BDC sector, that's business development companies, got hit hard when the Federal Reserve started cutting rates in 2024 and continued into 2025. Effective yields on loan portfolios dropped. One analysis noted Trinity's own effective portfolio yield dropped from 16.4% in Q4 2024 to 15.2% in Q4 2025, a direct consequence of 75 basis points in rate cuts over 2025. The entire sector felt that squeeze, and several major names responded by trimming payouts. So when you find a company still paying over 13% and they've never cut, the smart question isn't, should I buy this? The smart question is, why hasn't it cut, and is that sustainable? Here's something that most high-yield content doesn't explain clearly. The whole reason BDCs offer these kinds of yields is because they lend money to businesses at floating interest rates. When the Federal Reserve raises rates, BDCs earn more interest income. When the Fed cuts rates, they earn less. It's a direct relationship. That's why the 2024-2025 rate cutting cycle put nearly every BDC under pressure. Income fell, payout ratios got tight, and stocks that weren't careful about how they structured their loans started showing real cracks. Here's where Trinity Capital is genuinely different from most of its competitors. Most BDCs let their loan interest rates float all the way down with the Fed, no floor, no limit. Trinity Capital structures a significant portion of their loans with interest rate floors. This means the Fed can cut rates multiple times before Trinity's loan income actually starts declining. Once rates hit the floor built into a loan contract, further rate cuts have no impact on that loan's income at all. Their CEO, Kyle Brown, confirmed this explicitly on their most recent earnings call. And according to their investor presentations, a 100 basis point rate decrease would have near zero negative impact on their net income investment, because so much of the portfolio is already at floor levels. That's not typical. To my knowledge, only one other BDC operates with a similar loan structure. That's Hercules Capital. Let's look at what Trinity Capital actually does and why the business model makes sense for income investors. Trinity is a specialty lending firm. They provide debt capital to growth-stage, venture-backed companies, businesses that have institutional equity behind them but still need debt financing for equipment, expansion, or working capital. Their borrowers typically have annual revenues up to $100 million, and they pay elevated interest rates because they carry real credit risk.
The firm operates in 5 lending verticals: tech lending, equipment finance, life sciences, sponsor finance, and asset-backed lending. As of their most recent reports, they manage over $2.8 billion in assets and are currently invested across more than 463 companies. Trinity was founded in 2008, which gives them a 17-year operating history, but they only went public as a BDC in 2019. That's an important distinction because the public track record is roughly 6 years old, and it's that public track record that matters for evaluating dividend reliability. The second structural advantage is something that sounds dry but matters enormously to your long-term returns. Trinity Capital is internally managed. Most BDCs outsource portfolio management to a third-party investment advisor who charges 1 to 2% of total assets, plus performance fees. That money comes directly out of income that could otherwise go to you as a shareholder. Trinity handles everything in-house. No third-party advisor, no management fee paid to an outside firm. This does 2 things. It saves significant money on costs, and more importantly, it aligns management compensation with actual portfolio and stock performance, not just how big the portfolio gets. Internally managed BDCs have historically outperformed externally managed ones on average, precisely because of this alignment.
Here's a behavioral pattern I see constantly in income investing. Someone discovers monthly dividend stocks. They get excited about the income. They build a portfolio around the 10 highest yielding names they can find. No filters, no structure, just yield. And it works until a rate cycle changes, or a sector hits turbulence, or a company's coverage ratio quietly drops below 1.0. That it doesn't work anymore. The mistake isn't caring about yield. Monthly income is meaningful, especially if you're living off a portfolio. The mistake is treating yield as a standalone metric instead of a signal that demands explanation. The question is never just how much does it pay, it's why does it pay that much and can it sustain it? Trinity's 13–14% yield reflects the real credit risk embedded in venture-stage lending, but that risk is paired with specific structural protections, rate floors, internal management, and a meaningful dividend cushion that change how you should evaluate the sustainability of that income. For the entirety of 2025, Trinity covered its dividend at 102%, meaning net investment income exceeded the dividend payout in both Q3 and Q4 2025. That's a tight margin, but it's coverage, not a deficit. And they hold a spillover cushion of 84 cents per share in undistributed income as of December 31st, 2025. That's not a small buffer. It represents nearly 5 months of the current $0.17 monthly distribution. If earnings were to dip temporarily below the dividend level, they have real accumulated capital to draw from before they'd ever need to consider a cut. Here's where I want to be transparent about something that changed between my original research and today. In Q4 2025, Trinity's NAV per share was $13.42, a positive sign, but more recent data shows NAV dipped slightly to approximately $13.05 in early 2026, a roughly 2.2% decline. That's not catastrophic, but it's worth watching. NAV erosion is one of the warning signs in BDC investing. If a company continuously pays out more than it earns and its underlying asset values decline, the dividend becomes less sustainable over time. Right now, the NAV situation is a yellow flag, not a red one, but it goes on the watch list. Let's be direct about the risks, because anyone who skips this section in a high-yield investment analysis isn't doing the job right. First, the borrowers are risky by definition. Trinity lends to venture-backed growth-stage companies. These are not blue-chip businesses. Some of them will fail. That's priced into the yield. Their non-accrual rate, the percentage of loans where borrowers have stopped making payments, was under 1% as of their last full-year reporting, which is well below the broader BDC sector average of around 1.62%. That's a strong number, but in a weaker economy, it could rise. More recently, their watch list investments, loans they're monitoring more closely, climbed from 3.3% of the portfolio to 5.3% in mid-2025. That figure bears watching as we move deeper into 2026. Second, share dilution is real. Trinity funds growth partly by issuing new equity. Their share count grew from 59.4 million to 77.0 million year over year as of Q4 2025. That's why NAI per share stayed relatively flat even as total NAI grew. You're sharing the income pie with more shareholders every time they issue new stock. Third, price volatility is significant. The 52-week trading range for TRIN spans from roughly $10.90 to $16.82, a swing of more than 50% from trough to peak.
At the current price, around $16, the monthly $0.17 dividend yields about 12.6 to 13% annualized. But if you bought at 16 and the stock drops to 12, you're collecting income while watching meaningful principal erosion. These two things don't cancel each other out. This is exactly why I opened a small position, around 1.7% of my overall portfolio, not because the thesis is weak, but because disciplined position sizing is what separates income investing from income gambling. If you're doing your own research on Trinity Capital or evaluating any BDC for your income portfolio, here are 5 metrics that matter most. 1. Dividend coverage ratio. Is NAI covering the dividend above 100%? Trinity's coverage is at 102%. Anything below 95% consistently warrants real scrutiny. 2. Spillover income per share. This is the cushion. Trinity carries 84 cents per share in spillover, nearly 5 months of the current distribution. Strong cushion gives the company room to absorb temporary earnings dips without cutting. 3. Non-accrual rate. You want this below 2%. Trinity is under 1%. Below average non-accruals signals strong underwriting discipline. 4. NAV trend. Is the net asset value growing, stable, or declining? A BDC paying a rich dividend while NAV steadily erodes is often a slow-motion problem. Trinity's NAV dipped slightly in early 2026. This is the number I'm watching most closely right now. 5. Interest rate structure. Does the company have loan floors that protect income in a falling rate environment? Most BDCs don't. Trinity does. That's a genuine structural advantage that most high-yield investors overlook entirely. Let me know what you think in the comments. Are you already invested in BDCs, or is this a corner of income investing you've been avoiding? I'd genuinely like to hear your take, especially if you see something in this thesis I haven't addressed. If you want to see more analysis like this, breaking down specific holdings, income metrics, and real portfolio decisions, subscribe and stick around. Thanks for watching.